Hello and welcome back, guys. I hope you're having a nice weekend. I'm adding more and more features to our exclusive tool here, and the latest one that I have added is called Market Trends. It's very handy because it tells you what are the current trends right now in the last hour or so. And so if you refresh, you get different data pretty much all the time. And as I was taking a look at this, this is automatically sorted by stock tweets impressions. This is the default, but you can actually sort by anything you like here. And so if I sort by Twitter posts and comments, you'll see that AMD is the one that is actually trending right now. But if you do it by stock tweets impressions, you will see that Netflix is more on the top, AMC here, for instance. And so you can find at least AMD is also up there, but it's mostly trending on Twitter right now. So as I was taking a look at this, I actually took a look at the ticker symbols just to see what people are out talking about this hour, basically, in this day. And the top core right now is Netflix and some other stocks, of course, Neo, Apple, Coca-Cola. But the interesting one to me was Twitter, and I actually wanted to make a little bit of a video about it. And so I'm going to click on Twitter. As you see, I basically just click and I immediately get the analysis. And this is actually even a little bit slow because it runs on my local machine. It's not up there on the internet where you have a massive server that actually handles things way faster. But still, it's pretty fast. And you will see here that Twitter has been down almost 50%. And now it's at $38.6. And so I think it's an interesting time to take a look at it, right? It's a little bit on an uptrend right now in the last few days. It used to be 33. Now it's sitting at 38.6. So what is Twitter doing here? Now, the first thing that you notice here is the decrease in the PE, actually the negative PE ratio and price to free cash flow ratio. And as you will see here, this has been firmly in the negative for a few years now. And the same thing with the price to free cash flow since 2020. It actually used to be positive back in 2020, as you'll see here. And outstanding shares are also increasing and increasing pretty much every year. So the company is diluting shareholders. At least it's 10%. It's not a massive dilution. This is the 5-year dilution, pretty much 10%. From 2017 to today is 10%. And so the 5-year revenue growth, so the company is selling, as you can see, but its net income is decreasing. So look at this. Back in 2017, they had more net income. It was negative, but it was still more. And they keep on losing. At some years, they actually had positive net income. But now they are doing worse, and the 5-year free cash flow growth is negative as well. And you'll see here that they were making 600 million, and now they are down to losing money. So that's not looking great, and that can actually tell you a story about why Twitter is down right now in terms of its stock price in the last year. And so we can, of course, take a little bit of a look at the deeper dive here. You will see a very high debt to equity ratio, which also keeps increasing. And I really like this inline graphs that we have added on the tool, because it tells me the story, what is going on here. The company has been increasing its debt, is what you can see here, and not really increasing its equity while debt is increasing. The current ratio is sitting at 5.89. So this is at least quite a little bit of equity, because current ratio is about the current equity divided by current liabilities, the current assets, not equity, divided by current liabilities. And so it tells you that for every $1 of debt, almost, we have $5.9 of assets. So that's a good figure. The price to book ratio is 4.22. Now that's not really red. You can actually say that this is fair. Now, typically, ideally, you want to be getting it near 1, but you won't be getting one from a tech company for the most part. You will be getting one mainly from like banks and things of that sort, more steady institutes that are about value so much and not so much about growth. But the return on equity here and basically the return on capital employed, all these returns are negative, as you can see. So the first picture is not great, and I can always take a look at the stock news here and see what's happening with the company. This is another very nice module that I love here, because they can give me all sorts of information about what is going on with the company. And it's very nice that it's tied to the company that you are examining. And we also have the market news one, which is a generic thing. And I will be going back to the financial statements here of the company, And we will take a little bit of a closer look. Now we know that the company's revenue is increasing, we saw that earlier, so that we do have increasing revenue, as you will see. But if we take a look at the net income of the company, the net income is decreasing. This is exactly what we saw earlier. And 2020 and 2021 have been bad years for the company. Now the balance sheet, we will take a look and see that the current assets of the company, the assets of the company and the total liabilities of the company are, now the total liabilities are 6.7, the total assets are 14.6, and this is very handy because they are pretty much well in together. And so the total equity here is increasing and increasing nicely over the years, but pay attention. Look at this additional paid in capital, 7.7 billion, 8.3, 8.7, 9.1, 8.4. Company keeps issuing stock and actually increasing. And we saw that this increase in the amount of shares. They keep increasing their stock and actually diluting investors, selling a lot of extra stock, and people are willing to buy. And this means that you are getting diluted and the company is making some capital because of this selling. But this is something that you don't really like to see, because this really affects the equity of the company and kind of is the reason why the company has assets. It's not the operations. And you will see that even better here if you take a look at the net cash provided by operating activities. This is operations from the company, and this is actually from 800 million to 600 million over here. And you will see that the company is actually losing operating income. Plus, look at this, depreciation and amortization and stock-based compensation is the biggest values. And these are just items that are not cash items, that are added back to operating activities and extracted from netting and from the income statement. And so you're getting a very weird and skewed operating activities cash here. So it's actually, if you exclude these values, it's mostly in the negative, because these are actual expenses. They are not cash expenses, but they are added back to the cash flow and really skew our results here. And this is why our discounted cash flow model helps a lot identify what's actually going there. We're going to do that next. But you will see here that common stock issued here. There has been a little bit of repurchase as well in the financing activities, and the free cash flow of the company is negative. And as you'll see here, it used to be positive, but now it's going worse and worse. Losing free cash flow is the last thing that you want to see from a company to invest in. So that's not looking great. And now I'm going to take a look at the stock evaluation tool, and I'm going to use the metrics of the company to project what they're going to be doing in the future. And so our 5-year average growth is 15%, which is a little bit minuscule for a company like Twitter. I would expect it to be more. Last year they did have 36, and the 3-year average is also higher than the 5-year average. That's a good thing. But I'm going to go with, let's go with 16, 18, and 20 here. And the net income margins, look, they are fairly suppressed here. And these years are the ones that are making it better. But look at this couple of years. So I have to go low here. I have to go like 3, 4, and 5, because the last couple of years have been bad for the company. So I don't want to overdo it. The free cash flow margin, again, as we saw, the company is struggling to make free cash flow. And this is why we're also adding the net income here, because we examined and saw that it's stock-based compensation and depreciation that actually allows for this extra appearance of free cash flow. But we want to correlate it with net income in order to make sure that we are not actually factoring in this free cash, like depreciation and stock-based compensation as actual free cash flow and skew our results. So this is why we're adding all this info in our cash flow model here, discounted cash flow model. So the free cash flow margin that we're going to use based on these values, again, we're going to go relatively low, because again, last year was great, but the previous year was negative. And the last 3 years have been 70%. So we're gonna go, let's go like 20, 22, and 24 here, which may be a little bit too much even. And an annual return of 13% is what I typically want to be getting from a company, just because I can get a 10% from a pretty regular S&P 500 ETF. And so I'm gonna hit calculate here. And you will see the actual value that this calculator actually projects for Twitter. And that is very low, and mainly because the company is not profitable, and it has actually been losing net income and free cash flow. And even though it's increasing its revenues, its actual free cash flow doesn't come from net income. So it's very, very skewed, like the values that you see. And even then, they are still negative. And look at this growth here; it's very, very negative here. So the actual free cash flow of the company looks worse and worse, and that's not great to see. And this is why we're looking at these values here. The margins are very suppressed. The free cash flow margin is also very suppressed. And even though there is some revenue, this really, really, brings down our what we should be willing to pay, because the company is not really making much money, and this means that they are a very risky investment to take right now. And this is why I would avoid Twitter. It's not even close to what I'd want it to be. I would wait for it to be much more profitable and actually utilize this revenue to make some actual cash that they will be able to keep and do much better in terms of their financials in the future. This is when I would revisit. So I hope you enjoyed the video. If you did, please leave a like and subscribe. And in case you did enjoy this one, take a look at this video that I made earlier. I'm discussing the current situation in the stock market, whether there's going to be a crash and what to do about it. And thank you for watching this one, guys. Have an awesome weekend. Bye bye.